Hey, welcome. Today, we are going to tackle one of the coolest and toughest puzzles in all of finance. How in the world do you put a price tag on the future? We're going on a journey through the evolution of options models. These are the brilliant and sometimes flawed formulas that humans invented to try and price uncertainty itself.
So let's just start with that big central question. You want to make a bet on where a stock is going. You want to buy an option. How do you figure out what a fair price is for that bet today? It's not just a gut feeling, right? It's a science. And believe me, that science has one heck of a story.
All right, so here's our game plan. We're going to start with what everyone thought was the perfect formula, one that even won a Nobel Prize. Then we'll see how the real world came back to bite, creating this weird thing called the volatility smile. After that, we'll look at the clever fixes people came up with, check out the modern computational tools in the toolkit, and finally, figure out how you choose the right weapon for the right job.
Okay, our story kicks off with an absolute game changer, the Black-Scholes-Merton model. This thing was a bombshell. It felt like someone had finally handed the financial world a perfect, elegant key to unlock the whole pricing puzzle.
You know, before BSM, pricing an option was kind of like voodoo, more art than science. This model was so revolutionary because it gave everyone a closed-form solution. That's just a fancy way of saying it was one clean, beautiful equation. You could just plug in your numbers, turn the crank, and out popped a price. The whole idea was built on this concept that you could perfectly hedge your bet, removing all the risk, which meant there could only be one fair price.
Now, for that beautiful math to work, the model had to imagine a perfect little world. And what's in this world? Well, it's a place where volatility, the chaos of the market, never changes, market moves are always gentle, following a perfect bell curve, and trading is free, interest rates never move, and options can only be used on their very last day. It's a beautiful, frictionless, mathematical paradise. The only problem? It's not the real world, not even close.
And this, my friends, is where the plot really thickens. What happens when you take this elegant formula out of its perfect laboratory and you throw it into the deep end of the real, messy, chaotic market? Well, let's just say reality bites back. Hard.
This slide just lays out the conflict perfectly. BSM says volatility is constant. Reality says, nope, it's random and it's changing every second. BSM assumes prices move in a nice, predictable way. Reality gives us flash crashes and wild rallies. BSM assumes trading is free and constant. Reality hits you with fees and market close times. Every single one of these broken assumptions starts to put a crack in the model's foundation, and that leads to big, systematic mistakes.
Let's really zero in on one of the biggest problems, these so-called fat tails. The math behind Black-Scholes says a massive single-day market crash is a one-in-a-million type event, something you'd expect to see maybe once every few thousand years. But we all know they happen way more often than that. Those fat tails on the graph just mean that extreme, wild events are way more common than the model gives them credit for, and that is a massive blind spot.
So if the model's price is wrong, what do traders do? Well, they cheat. They keep the formula, but they work backwards. They look at the actual price of an option trading in the market, and they say, okay, what number for volatility do I have to jam into this formula to make the math work out to this real price? That number, that fudge factor, is called implied volatility. It's basically the market screaming at the model, telling it what the real volatility is.
And this is just brilliant. It shows the problem so clearly. See, if Black-Scholes was right, the implied volatility for all options on a stock should be the same. It should be a flat line. But it's not. When you actually plot it out, you get this smile shape. What that tells you is that the market is charging a higher price, demanding a higher volatility premium for options that are way out of the money. Why? Because the market knows those fat tail events are real. This smile is the smoking gun that proves the model's biggest assumption is just plain wrong.
So, once the cat was out of the bag and everyone saw the flaws, the race was on to build something better. The next wave of quants got to work, and they focused on fixing two main things: those crazy market shocks and the simple fact that volatility itself is always moving.
And really, two big ideas came out of this. On one side, you had Robert Merton, who said, hey, let's just add random jumps into the price path to account for those big shocks. That helps with the fat tails. But on the other side, you had Stephen Heston, who said, wait, the problem is deeper. Volatility itself is a moving target. So his model treats volatility as its own separate random thing. Each one was a huge step forward, but neither was perfect.
The way the Heston model works is actually pretty cool. You can think of it like a sound engineer's mixing board, but for shaping that volatility smile. It has all these different knobs you can turn. There's a correlation knob that controls the skew, or the lopsidedness of the smile. There's a vol-of-vol knob that controls its curvature, or how steep the sides are. It gives you the power to actually tune the model to match the smile you're seeing in the real market.
But here's the thing. Even these super smart formulas have their limits. For a lot of the most common options out there, like American options, which you can exercise anytime you want, there's no single elegant equation. So what do? We have to bring in the big guns, raw computing power and numerical methods.
One of the real workhorses here is the binomial model. Its logic is just brilliantly simple. You build this tree of all the possible ways the price could move, step by step into the future. Then you start at the very end, at expiration, and you work your way backwards to today. And here's the crucial part. At every single step, at every node on that tree, the model asks a simple question. Is it better to hold on to this option or cash it in right now? That ability to check for early exercise is what makes it the go-to for American-style options.
And then you've got the heavyweight champion of flexibility, Monte Carlo simulation. This thing is pure brute force. Forget a structured tree. This method just simulates thousands, sometimes millions of random possible futures for a stock price. For every single one of those random paths, it figures out what the option would be worth at the end. Then it just takes the average of all those millions of outcomes and brings that value back to today. It takes a ton of computer power, but it can handle pretty much any bizarre, complex option you can throw at it. So, now we've got this whole toolkit, right? We've got these elegant formulas, we've got these powerful computer simulations. So that brings us to the most practical question of all. How do you choose the right weapon for the job? Because spoiler alert, there is no single best model for everything. Let's just look at the raw data for a second. This chart is awesome. It shows the average error when you compare these models to actual market prices. You can see Black-Scholes and the Merton jump model are off by about 5 to 7%. But then look at Heston, the one that lets volatility be random. Its error plummets to just over 2%. It's a crystal clear picture of how much accuracy you gain when you finally start modeling volatility realistically. And that right there brings us to the fundamental trade-off that every single quant has to deal with. This table nails it. Black-Scholes, super simple, but not very accurate. Heston, incredibly accurate, but it is an absolute beast to implement and calibrate. The takeaway is simple. If you want more accuracy, it's almost always going to cost you in complexity. So here's your practical cheat sheet. If you just need a quick quote or benchmark, everyone still speaks the language of BSM. Got an American option? You're using the binomial model. Dealing with something really exotic and weird, fire up the Monte Carlo simulation. But if you need to be dead-on accurate for pricing and hedging your risk, you need a sophisticated model like Heston. And if the market is crashing, you better be using a model that understands jumps. And let's be really clear about something. This isn't just a fun academic exercise. The model you choose has massive, direct, real-world consequences. If you use the wrong model, you are mispricing your risk. And mispricing risk is how you lose a catastrophic amount of money. Getting the model right is absolutely essential to surviving in finance.
And the story is far from over. I mean, the edge of quantitative finance is already moving on to the next thing. You've got people exploring ideas like rough volatility, which says market moves are even more jagged and unpredictable than we thought. And of course, everyone is trying to use machine learning to uncover patterns in the data that our old models could never see.
Which kind of leaves us with this one big final thought. This whole journey, from that one simple formula to these massive simulations, it's all been about trying to draw a better map of a very messy reality. So the question is, will we ever find that one single perfect map? Or is the future of finance just destined to be this constant race between our own ingenuity and a market that will always...
All right, let's jump right in. What if I told you there's a way to predict the future just by, rolling the dice a million times? It sounds kind of crazy, but that's the basic idea behind something called the Monte Carlo simulation. And it's an incredibly powerful tool for taking all that messy real-world uncertainty and turning it into a map that you can actually navigate.
But to really get why this matters, let's start with a question that I'm sure you've asked yourself. Why is it that big, ambitious projects always seem to go off the rails? They're always late, always over budget. It doesn't matter if it's a new skyscraper or a new piece of software. Well, the answer really comes down to one thing: how we handle the unknown. So, you see, the problem usually starts right at the beginning. It's because we as humans, we crave certainty. We want one single, clean number to answer a really messy question. We call this a single point guess. And this is where everything starts to fall apart. Think about it. When you say, this project will cost exactly $10 million, that single number is, well, it's incredibly fragile. It completely ignores the thousands of things that could go wrong, right? Supply chain nightmares, labor strikes, a sudden storm, you name it. In a world as complex as ours, a single guess isn't really an estimate. It's kind of like pretending you have a crystal ball when you really don't. Okay, so if making one single guess is such a bad idea, then what are we supposed to do? Well, the answer actually came from a pretty unexpected place, and it was born out of pure necessity right in the middle of World War II. So the story goes like this. You've got these brilliant mathematicians, Stanislav Ulam and John von Neumann, working on top-secret nuclear physics problems during the war. And these problems were so incredibly complicated, normal math just couldn't crack them. Then, Ulam has this aha moment, supposedly inspired by his uncle who loved to gamble. He thought, what if we stopped trying to find one perfect, calculated answer? What if, instead, we just used randomness? We could simulate thousands of different possible futures and just see what happens most of the time. And that, right there, is how it got its name, Monte Carlo, after the world-famous casino. It's all about chance and probability. So, when you boil it all down, what is a Monte Carlo simulation? Well, think of it like a prediction engine, an engine that runs the future not just once, but thousands upon thousands of times. You feed it every single thing you're uncertain about, but instead of a single number, you give it a whole range of possibilities. Then it runs all those scenarios and spits out this incredible, detailed picture of what's most likely to happen. The bottom line is, it takes that scary, fuzzy uncertainty and turns it into a clear map. Okay, that sounds amazing, right? But how does this prediction engine actually work? Well, it's actually a pretty straightforward 4-step process. Let's dive in and see how it's done. All right, so here's how it goes. Step 1, you build a simple mathematical model of whatever you're trying to predict, say a project budget. Easy enough. Step 2, and this is really the secret sauce. You identify everything that's uncertain. Material costs, how many hours it'll take, everything. And for each one, you don't give it one number. You give it a range of possibilities, what we call a probability distribution. So instead of saying labor will take 100 hours, you say, well, it'll probably be around 100, but it could be as low as 80, or if things go wrong, as high as 150. See the difference? Then step 3, you just hit go. The computer rolls the dice, picking a random value for each variable from within its range, and calculates one possible final cost. And then it does it again, and again, and again, thousands of times. Finally, step 4, you just look at all those results together. That's what gives you the full picture. And when I say thousands, I'm not kidding. To get a really solid result that you can actually trust, we're often talking about 10,000 runs, or even more. This is basically brute force statistics. You're throwing so much computational power at the problem that you explore every nook and cranny of what's possible. That way, you know the final probability map is the real deal. Okay, so that's the theory. That's how it works. But where are people actually using this stuff to make better decisions? Well, the truth is, it's pretty much everywhere, from the high-stakes world of financial markets all the way to the concrete reality of a factory floor. I mean, look at this list. For finance, it's absolutely essential for figuring out the real risk in a portfolio. For project managers, it's the gold standard for predicting those cost and schedule overruns we started with. Supply chain experts use it to model what happens if a factory goes down or demand suddenly spikes. And engineers, they can stress test a new bridge design under thousands of different conditions before a single piece of steel is ever ordered. It really is like a universal translator for risk. Let's just zoom in on the finance world for a second because it's a perfect example of how this technique changes the game. See, it's one thing to know that you might lose money, but the really important question is, if things go bad, just how bad could it get? It's all about understanding the magnitude of the potential disaster. And this is where we can see a huge shift in thinking. For a long time, the standard way to measure risk was something called value at risk, or VAR. VAR basically asks, okay, 99% of the time, what's the most I'm going to lose? Which sounds okay, right? But here's the massive, glaring flaw. It tells you absolutely nothing about what happens in that worst 1% of cases. That's where conditional value at risk, or CVAR, comes in. It asks a much smarter question. In the scenarios where things go really bad, what's my average loss going to be?
It forces you to stare into that abyss and understand the true severity of those worst-case, tail-risk events. It's just a much more honest way to look at risk.
Okay, and this brings us to what I think is the most powerful part of all this, because a Monte Carlo simulation doesn't just dump a giant cloud of data on you. Its real magic is helping you find the crucial signal hidden in all of that noise. Because here's the thing, after running all those thousands of scenarios, you get more than just a simple chart of probabilities. The simulation can actually act like a detective. It can look back at all the results and tell you which of your initial uncertain variables had the biggest, baddest impact on the final outcome. So it doesn't just wave a flag and say, hey, there's a risk. It points its finger and says, the risk is coming from right there.
Now, there's a fancy name for this. It's called probabilistic sensitivity analysis. But the idea is simple, and it's a total game changer. Let's say your simulation shows a big risk that your project is going to be late. This analysis will then give you a chart that looks something like this. It actually ranks the culprits. It might tell you, hey, the possibility of a labor shortage, that's driving like 70% of your risk of being late. But bad weather, that's only about 5%. Instantly, boom, you know exactly where you need to focus all of your energy and attention. And this is where the strategy comes in. The research puts it perfectly. By focusing management attention on the small subset of inputs identified as the primary drivers, organizations can achieve the highest return on risk reduction. In other words, you stop wasting time and money worrying about 100 different little things, and you pour all your resources into managing the 2 or 3 things that actually matter. It's the biggest possible bang for your buck. So, at the end of the day, this is the real takeaway. The Monte Carlo simulation is so much more than a fancy calculator. It's a tool that completely changes how we think about the future. That big, scary, unknown thing we call uncertainty stops being this terrifying monster in the dark. Instead, it becomes a strategic landscape, a detailed map that shows you the paths, the probabilities, and the pitfalls, so you can make smarter, tougher decisions. So, I'll leave you with a question to mull over. Just think about it for a second. If you could have this kind of map for any big decision in your own life or your own work, if you could see the whole landscape of risk and know exactly what to worry about the most, what would you change? What decision? Today, we're cracking the code on financial forecasting. And here's a spoiler. For the pros, it's not really about predicting exact prices. It's about predicting risk. Let's dig into how they actually do it. I mean, this is the million-dollar question, right? It's what everyone from Wall Street traders to folks managing their own retirement funds wants to know. You see a stock on a hot streak, you jump in, and poof, it goes the other way. Why does it feel so random, so impossible to get ahead of? Well, the answer is kind of fascinating. It's because what we see on the surface, those daily ups and downs, is actually masking a much deeper, more chaotic truth. And once you understand that truth, you're on your way to building a real forecasting model. Okay, so this brings us right to the first major hurdle we have to get over, this illusion that we can just look at a chart and somehow know where the price is going next. The heart of the problem is a statistical concept called a random walk, and it's a tough pill to swallow. It basically says that a stock's next move is, for all intents and purposes, random. It's like a coin flip. The single best, most logical guess for tomorrow's price is, well, whatever the price is today. Any patterns you think you're spotting, more often than not, they're just illusions. This is exactly why trying to predict a specific price target is a recipe for disaster. So if predicting the price is a dead end, what's the move? Do the pros just give up? No way. They just change the question they're trying to answer. And that brings us to our first real tool for the job, ARIMA. And this slide just illustrates that pivot perfectly. Instead of chasing that wild, unpredictable price, analysts shift their focus to something way more manageable, the daily change in price. We call that the return. So the game is no longer about asking, hey, is this stock going to hit $150? The new, smarter question is, what's the probability it goes up or down by a little bit tomorrow? It's a total game changer. Now, before you can build any kind of reliable forecast, you need a stable foundation. In statistics, we call this stationarity. All it really means is that your data is playing by a consistent set of rules. You know, the average daily change isn't just drifting off to the moon, and the swings aren't getting crazier and crazier over time. Without that basic stability, any model you build is basically built on quicksand. And analysts don't just, eyeball it and hope for the best. They have to prove the data is stable. They actually use 2 different statistical tests, kind of like getting a second opinion from a doctor. One test actively looks for instability, while the other looks for stability.
And only when both tests give you the green light can you confidently say, okay, this data is ready to be modeled.
All right, so once that data is confirmed to be stationary, the first big tool they pull out of the toolbox is ARIMA. It's built from 3 key parts. The AR bit looks at how today's change relates to yesterday's change. The I part, well, that's just the step we took to make the data stationary in the first place. And the MA part is really clever. It looks at the errors from past forecasts and uses them to make the next one better. It's the absolute workhorse for finding those small, predictable wiggles in the data.
So there we have it, a model to predict the direction of daily returns. We're done, right? Problem solved? Not even close. It turns out the ARIMA model has a huge, massive blind spot. And that blind spot has a name: volatility clustering. The best way to think about it is like financial weather. Some days are calm, quiet, not much happening. And then you get these intense storms where big price swings, up or down, doesn't matter, are immediately followed by more big swings. This clustering, this is the very definition of market risk. And here it is, ARIMA's fatal flaw. By its very design, it assumes that the size of its forecast errors, the variance, is constant over time. It completely misses the financial weather. It's blind to the difference between a calm summer day and a Category 5 hurricane. And if your job is to manage risk, well, that makes the model dangerously incomplete. So we clearly need another tool. We need one built specifically not to predict the direction, but to predict the storminess itself. And that tool is called GARCH. This idea actually came together super fast. Back in 1982, the first version, the ARCH model, was created to link today's volatility to yesterday's big market shocks. But just 4 years later, the GARCH model came along and made a massive improvement. It not only looked at past shocks, but also past volatility itself, making it way more powerful and the industry standard we still rely on today. And look, you don't have to take my word for it. This quote from our source material absolutely nails it. GARCH isn't some fancy optional add-on. It is a prerequisite. If you're estimating risk, pricing options, building a portfolio, you simply cannot do it right without modeling this ever-changing volatility. GARCH is quite literally the language of risk. But, of course, the market still has one more curveball to throw at us. It's called the leverage effect. And in plain English, it just means bad news hits harder. A 2% drop in the market creates way more fear and future instability than a 2% gain creates confidence and calm. The basic GARCH model misses this because it treats good news and bad news as equals. So to handle this, the GARCH family had to evolve. Smarter models were developed that basically have a bad news switch built into their math. The moment a negative shock hits, they automatically add an extra dose of volatility to the forecast, which gives a much more realistic picture of the coming turbulence.
Okay, this brings us to how the pros really do it. See, it's not about choosing ARIMA or GARCH. The real magic happens when you combine them into a powerful 2-stage process. And here's how that 2-step dance works. It's so elegant. First, you run an ARMA model, which is just ARIMA without the I part for data that's already stationary, to get your best guess on the direction of the return. Then you take all the stuff it got wrong, the errors or the noise it couldn't predict, and you feed that into a GARCH model. So the second step models and forecasts the risk surrounding your initial prediction. It's absolutely brilliant.
And finally, you can't just build the model and walk away. Professionals are obsessed with testing their work. They run a whole battery of diagnostic checks. They have specific tests to make sure the first step did its job on direction, and other tests to confirm the second step soaked up all the volatility. It's all about building a model that you can actually stand behind and trust.
All right, so that's the classic playbook, the econometric approach that's been the standard for decades. But we live in the age of AI, right? So how does this old school method stack up against the new kid on the block?
And this is where it gets really interesting, because it's a classic trade-off. The ARMA-GARCH model is what we call highly interpretable. You know exactly what each part of the equation is doing and what it means for risk. On the flip side, a deep learning model, like an LSTM, can find these incredibly subtle, complex patterns that the classic models would never ever see. The catch? It's often a total black box. You don't always know why it's making the predictions it's making. But this brings us to the final and maybe the most crucial point of all. Even in a world that's becoming dominated by AI, the GARCH framework isn't going anywhere. Why? Because you might use an AI to get a tiny edge on predicting direction, but when it comes to calculating the actual, quantifiable, regulatory compliant risk measures, GARCH is still indispensable. It's the gold standard. Which really just leaves us with one big final thought to chew on. We've gone from thinking the market is a simple random walk all the way to building these sophisticated hybrid AI models. We're getting better and better at seeing what might be coming. But as our tools get sharper, does that fundamental uncertainty, that core risk of the market, ever really go away? That's something to think about.
All right, let's talk about something really cool today: vectorized backtesting. This is a technique that gives financial researchers a kind of superpower: the ability to test thousands, even tens of thousands of trading ideas at an absolutely blistering pace. It's all about finding that edge, that alpha, without spending years doing it.
And that really gets to the heart of the problem, right? Imagine you're a quant, and you have this universe of potential strategies. How do you even begin to test them all? How do you sift through 10,000 different ideas without the project taking literally forever? Well, this is the exact problem that vectorization was invented to solve.
So before we jump into the deep end, let's make sure we're all on the same page. What is backtesting? Think of it like a time machine for your trading ideas. You take your strategy, you run it on historical data, data from the past, and you see how it would have played out. It's the critical homework you have to do before you ever think about putting real money on the line.
But, and this is a big but, this whole process isn't as straightforward as it sounds. It's actually built on this fundamental tension, this constant trade-off that every single quantitative researcher deals with. And really, understanding this dilemma is the key to understanding why we even have different ways of backtesting in the first place.
It really all boils down to juggling these three pillars. You've got speed, pretty obvious. How fast can I get an answer? Then there's fidelity. How close is my simulation to the messy, chaotic reality of a live market? And finally, robustness. Does my idea only work in one specific scenario, or can it actually survive out there in the wild? Here's the catch. You can't have it all. You can't maximize all three at once. You always have to make a choice.
And when your choice, your number one priority is pure, unadulterated speed, well, then the answer is vectorization. This entire approach is built from the ground up for one thing: to be the fastest way possible to test an idea.
So how on earth does it work? Well, imagine you're reading a book. A traditional computer loop is like reading it one letter at a time. It's painfully slow. Vectorization, on the other hand, is like being able to absorb the entire page or maybe even the whole chapter in a single glance. It processes entire columns of data, like every closing price for the last decade, in one single blazing fast operation.
And the tech that makes this happen is just fascinating. This is not some simple Python trick. We are talking about super high-performance libraries like Pandas and NumPy that are running highly optimized C and Fortran code behind the scenes. They even tap into special hardware features on your computer to do one calculation on many pieces of data at the exact same time. The entire goal is to completely get rid of those slow, clunky Python loops and let the raw metal do the work as fast as it possibly can.
And this slide just lays out the magic perfectly. Instead of going step by step, you do everything in these massive batches. First, boom, you calculate your indicator, like a moving average, for every single day in your data set all at once. Then, boom, you generate a buy or a sell signal for every single day all at once. And finally, you guessed it, you compute the returns for every trade all at once.
Okay, but remember that trade-off we talked about? Well, here it comes. This mind-blowing speed doesn't come for free. There is a hidden and pretty significant cost, and this really gets to the core conflict of all backtesting. I like to think of it as a drama with two main characters. On one side, you have the vectorized speed demon. It's incredible for discovery, for just tearing through thousands of ideas to see what might work. On the other side, you have the event-driven realist. This method is slow, it's careful, it goes one step at a time, because its job is to mimic the nitty-gritty details of a live market with the highest accuracy possible.
And this table just lays it all out crystal clear. Vectorized is all about batch processing. That's where it gets its insane speed, but it's also why its fidelity, its realism, is low. It kind of has to guess at things like transaction costs, or just ignore them. The event-driven approach, though, it uses a sequential loop. It's way slower, but its fidelity is high, and it can model costs as they happen. And that last row is absolutely crucial. Event-driven code can often be reused for live trading, while vectorized code is a pure research tool. You'd never trade with it directly. So let's drill down into that fidelity gap. What is the speed demon actually missing? Well, a lot of important stuff. Things like slippage. That's when the price moves against you in the split second you're trying to trade. Or partial fills, where you don't get your whole order filled. These are all path-dependent problems, meaning what happens now depends on what happened a moment ago. And that's the complete opposite of the all-at-once philosophy of vectorization.
Now, with all this talk about processing huge batches of data at once, you might be wondering, wait a minute, how do you make sure you don't accidentally use information from the future to make a trade in the past? That is a giant risk, and there is one specific function that is your absolute main line of defense.
The source material puts it perfectly. This is, and I quote, the researcher's main defense against look-ahead bias. Honestly, this is the single most important thing you have to get right in a vectorized backtest. If you mess this up, your entire result is totally worthless.
And here it is. It looks so simple, doesn't it? Just .shift 1. But this little piece of code is basically the safety switch on your time machine. Think about it. You generate a signal based on today's closing price, right? Well, you can't actually place that trade until tomorrow. This function does exactly that. It pushes your entire list of buy and sell signals forward by 1 day, guaranteeing that every single trade is based only on information that was actually available at the time.
Because if you forget to do this, you fall into the deadliest trap in all of quantitative finance: look-ahead bias. It's when your simulation accidentally gets a peek at the future, and it always leads to these too-good-to-be-true results that look amazing on paper but are completely impossible in the real world. Getting that shift right is everything.
So, we have the fast but flawed speed demon and the accurate but slow realist. So what do the pros do? How do they solve this dilemma? Well, they don't choose. They use both.
And here's what that professional workflow looks like. It's a two-step process. First, you unleash the speed demon. You use a vectorized system as a massive filter to churn through thousands, maybe even millions, of ideas and parameters. You find that small handful of candidates that actually show some promise. Then, and only then, do you take those few survivors and put them through the ringer with a high-fidelity, event-driven simulation.
And this is why this matters so much. This hybrid approach gives you the absolute best of both worlds. It lets you cast a massively wide net during the discovery phase, but it stops you from getting fooled by those perfect zero-friction results. That second validation step introduces all the realistic pain, the costs, the slippage, all of it. It's a true survival of the fittest process that makes sure only the most robust strategies even make it to the finish line.
So, it all leaves us with one final critical question that you should ask of any backtest result you ever see. Your strategy passed the test? Great. But what kind of test was it? Was it a test of pure theoretical speed, or was it a true test of reality? Because knowing the difference, well, that's what separates.
Ever look at the chaos of the financial markets and wonder if there are hidden patterns, little ghosts in the machine just waiting to be found? Well, it turns out there's a special kind of hunter that does exactly that. Today, we're diving deep into their world, the world of statistical arbitrage. It all really boils down to one huge question. Are financial markets actually truly efficient? You know, does every single price at every single moment reflect all the information out there? The answer to that question is what the entire world of modern finance is built on. And while the old textbooks might say, yep, they're efficient, there's a whole army of quantitative analysts, or quants, armed with supercomputers and some seriously heavy-duty math, and they are betting trillions of dollars that the answer is a hard no. They believe the market has glitches, little temporary mistakes, and they've built a massive industry to hunt them down. So how in the world do they actually hunt for these glitches? Well, it all comes down to one core idea: finding those temporary pricing mistakes and exploiting them before they disappear. Okay, first things first, it's super important to understand this is not the risk-free arbitrage you might have heard about. You know, like buying a stock for $1 on one exchange and instantly selling it for $1.01 on another. That's a sure thing. Statistical arbitrage, well, it's a whole different beast. It's a game of probabilities. You're making a bet that a historical pattern will repeat, but there is absolutely no guarantee that it will. The whole game is really built on this one powerful concept: mean reversion. Here's a great way to think about it. Picture a dog on a leash, right? The owner is walking in a straight line,
The dog might run off to the left, sniff something on the right, but it's always eventually pulled back toward the owner. That leash is like the average price relationship between two assets, and when one of them strays too far, it tends to get pulled right back. And that leads us right to the classic strategy here, the pairs trade. So let's say you find two stocks that almost always move together, like Coke and Pepsi. They're basically joined at the hip. Then all of a sudden, for no obvious reason, Pepsi stock shoots way up while Coke's kind of stays put. That gap between them gets weirdly wide. A quant sees this and bets on that leash yanking them back together. So they do something clever. They short the winner, Pepsi, and they go long on the loser, Coke. And then they wait. When the prices snap back to their normal relationship, they close out both trades and boom, they pocket the difference. But, finding these pairs isn't just a guessing game. Not at all. It requires a pretty sophisticated statistical toolkit to separate a real relationship from just random market noise. And here's a really crucial point. We're talking about something way more powerful than simple correlation. See, two stocks might move together just because the whole market is going up. What quants are really looking for is a statistical property called co-integration. Think of it as the mathematical proof that the leash is real, that there's a genuine long-term balance between the two, and any split-up is probably just temporary. Okay, so once they've found a coin-integrated pair, they model its behavior using some pretty intense math, like something called the Ornstein-Uhlenbeck process. Now, this model doesn't just say, hey, the gap will probably close. It actually estimates how fast it will close, and that gives them this key number called the half-life, basically the time it should take for that price gap to shrink by half. A short half-life, perfect. A long one, that's bad news, because it means your money is tied up and exposed to risk for way too long. But simple pairs trading, like we just talked about, that was just the beginning. The history of StatArb is just a relentless, high-tech arms race, with the strategies getting faster and way more complex every single year. I mean, just look at this timeline to see how fast things escalated. Back in the 80s, it was all about these simple pairs. Fast forward to the 90s, and quants are trading these huge, complex baskets of hundreds of stocks. Then in the 2010s, they start using things like Kalman filters. That's the same tech used for missile guidance, by the way, to adjust their trades in real time. And now? Well, now it's all about AI. The strategies today are using these incredibly powerful AI models, like the same convolutional neural networks and transformers you hear about everywhere else, to spot these unbelievably subtle patterns that might only exist for a few seconds. The profit on any single trade is microscopic, so the only way this works is with high-frequency trading systems that can blast out thousands of orders a second. So all of this sounds pretty genius, right? Almost foolproof. But what happens when these incredibly complex mathematical models built entirely on what happened in the past, suddenly crash into a future they never, ever saw coming? And that right there, that quote, gets to the absolute heart of the single biggest danger in this whole game: model risk. It's the terrifying idea that your most basic assumption, that the past is a good guide for the future, just stops being true. The leash snaps. And this risk often hides in plain sight because of bad testing. Quants can easily fool themselves with a couple of critical mistakes. First, you've got survivorship bias. That's when you test your strategy only on companies that are still around today, completely ignoring all the ones that went bankrupt. Just doing that can make your results look almost 4% better per year than they really are. Then there's look-ahead bias, which is like accidentally using tomorrow's newspaper to make today's trades in your simulation. Both of these create a dangerously false sense of security. And if you want to see just how catastrophic model risk can be, well, we have to talk about the most infamous cautionary tale in the entire history of quantitative finance: the collapse of long-term capital management. Now, LTCM wasn't run by a bunch of amateurs. This was an absolute dream team. We're talking Nobel Prize-winning economists and the most legendary traders on all of Wall Street. They were considered gods, basically infallible. Their whole strategy was built on finding tiny, tiny price differences in global bond markets. And to turn those tiny profits into giant returns, they used a truly mind-boggling amount of leverage. At their peak, for every single dollar of their own money, they were controlling $30 of assets. Their total positions were worth over $1 trillion. And then, August 1998, the totally unexpected happens. Russia defaults on its debt. And that one event triggers this massive global panic, a flight to quality, where terrified investors all over the world dumped anything that seemed even slightly risky and piled into safe U.S. government bonds. And in that moment,
Every single relationship, every correlation their models were built on, shattered. All at once. All those leashes didn't just snap. They flew apart in opposite directions. The fund started hemorrhaging hundreds of millions of dollars a day. Their positions were so enormous that they couldn't possibly sell them without crashing the entire global financial system. So, in the end, the U.S. Federal Reserve had to actually step in and orchestrate a $3.625 billion bailout from Wall Street's biggest banks just to stop a complete and total meltdown. The ghost of LTCM, it still haunts the world of quant finance today. It forced everyone to rethink the absolute limits and risks of these strategies. And that led to what we now call the arbitrager's dilemma. We now understand that there's something called a statistical limit of arbitrage. It's a really fascinating idea. It basically says that even if you had perfect models and zero trading costs, there is a hard ceiling on how much money you can make. Why? Because the signals you're trying to find are buried in so much random statistical noise, you can never be 100% sure you found a real pattern. And that uncertainty itself acts as a natural brake on the whole system. And that brings us right back to the central lesson of LTCM, and the question that every single quant has to wrestle with every day. You can model decades of historical data, you can build these unbelievably complex algorithms, but can any amount of math, any algorithm, ever truly model the sheer, irrational force of human panic? That remains the ghost in the machine. All right, today we're going to peel back the curtain on the crazy, high-speed world of finance. We're looking at how AI is going from just a simple tool to a powerful, autonomous player. We're talking about the rise of agentic AI and algorithmic trading, where these bots aren't just following orders anymore, they're actually starting to think. So let's dive right in. You know, it all really starts with this one fundamental problem. Modern financial markets, they move at speeds that are just unimaginable. We're talking about data flows that are way too fast for any human brain to process. So how do you even compete in that environment? How do you win a game that's literally played at the speed of light, where your own human emotions, your slow reaction times, they're not just a disadvantage, they're a massive liability? Well, the very first answer to that big question was what we call the algorithmic trading revolution. The whole goal was simple. Take the slow, emotional, and often irrational human out of the equation and replace all that messy instinct with cold, hard, automated rules. And at its core, algorithmic trading, or AT for short, is pretty much exactly what it sounds like. You're using computer programs to automatically place trades based on a set of rules you've already given it. And this was a total game changer. It was designed to completely strip out that emotional bias from trading and execute orders with a speed and an efficiency that, let's be honest, a human could never ever match. So the first wave of these algorithms, they had really clear, pretty simple jobs. Let's say, for example, a huge pension fund wants to buy 1 million shares of a stock. They can't just dump that massive order onto the market all at once, right? That would completely spook everyone and send the price soaring. So an algorithm's job was to be stealthy, to slice that huge order into thousands of tiny bite-sized pieces to avoid making any waves. So how did they even know if these early systems were doing a good job? Well, they were often judged against two classic and actually pretty clever benchmarks. First, you've got TWAP. Think of it as the steady approach. It just breaks an order into equal chunks and executes them at regular intervals. It's predictable, it's stable. Then you have VWAP, which is more of a flow follower. It's a bit smarter. It tries to trade in proportion to how busy the market is, aiming to get the true average price based on all the trading volume. But, you know, simple rules can only get you so far. As markets got even faster and way more complex, traders realized they needed something that could do more than just follow a script. They needed something that could actually learn. And that's exactly where the machine learning toolkit comes into play. First step in the toolkit is supervised learning. And the best way to think about this is like a weather forecaster. It looks at mountains and mountains of historical data, where every single day is neatly labeled with what happened. And it learns to predict what might happen next. You're basically asking it, hey, given all these market conditions yesterday, what do you think the stock price is going to do tomorrow? Next, we have unsupervised learning. And this one is like the detective. With this, you don't give it any labels, you don't give it any clues, you just hand it this massive, messy pile of market data and say, go find something interesting. It's literally designed to discover these hidden patterns or strange connections that no human analyst even knew to look for in the first place. And finally, we get to my favorite, reinforcement learning. Now, this is where things get really exciting. Imagine a rookie pilot learning how to fly. They don't just sit and read a textbook, right? No, they get into a flight simulator and learn through pure trial and error. Well, that's reinforcement learning. An AI agent gets to play the market in a simulation, getting rewarded for good trades and penalized for bad ones over and over and over until it literally teaches itself how to become a master trader.
So, here you have it, the entire toolkit at a glance. You've got supervised learning for making predictions, unsupervised for discovery, and then reinforcement learning for figuring out the absolute best action to take. Each one has its own superpower, but each one also faces a really tough, unique challenge when you try to apply it to the incredibly noisy, chaotic world of finance. And this brings us to a really critical turning point in the story, because the industry pretty quickly realized that just being able to predict the future, well, that wasn't nearly enough. And here's the absolute crux of it. A perfect prediction is completely and utterly useless without the perfect action to go along with it. I mean, think about it. Knowing the market might go up is one thing, but knowing the best way to actually trade that insight, how much to buy, exactly when to buy it, how to place the order to not mess up the price, that is a totally different and frankly much, much harder problem to solve. And that's precisely why so many of the early trading systems that were built just on prediction models, well, they often failed. They completely ignored all the messy real-world details, things like transaction costs, the fact that your own big trades can actually move the market against you, and the reality that trading isn't just one big decision. It's a constant stream of smaller ones, one after the other. This is exactly the problem that reinforcement learning was practically born to solve. It works in this constant feedback loop. The agent takes an action, the market reacts, and then the agent gets a reward or a penalty based on the outcome. It does this millions, even billions of times, learning not just what might happen, but the optimal policy, which is just a fancy word for the best possible sequence of actions to take in any given situation to get the biggest reward. Okay, so with this incredibly powerful new tool in hand, these quantitative firms started chasing after what you could call the two holy grails of AI trading. And really, those two goals are pretty simple to wrap your head around. It's either about generating alpha, which is just Wall Street speak for making money by outperforming the market, or it's about achieving optimal execution, which is all about saving money by executing your trades in the most efficient way you possibly can. So, making money or saving money, that's it. Now, when it comes to generating alpha, machine learning is just incredible at finding these subtle, complex patterns that all the older models would just completely miss. It can detect things like the telltale signature of panic selling in the data or the patterns of investors chasing momentum, and then it can build strategies to actually capitalize on those very temporary, very human behaviors. And for optimal execution, deep reinforcement learning, or DRL, is absolutely state-of-the-art. Remember that pension friend we talked about earlier? A DRL agent can learn the perfect strategy to buy those millions of shares, constantly balancing the need to act fast against the risk of pushing the price up and costing itself money. Ultimately, this can save millions of dollars in execution costs for pensioners. Now, I know this all sounds pretty amazing, maybe even easy, but let's be really clear here. Building these systems is incredibly, incredibly difficult. The quantitative firms that do this face some massive real-world challenges. Okay, so first, financial data is famously noisy. It is just a mess, and trying to find the real signal in all that noise is super hard. Second, and this is probably the most important one, the market itself is always changing. A pattern that worked like a charm last year might completely disappear tomorrow. And this leads to a huge risk of overfitting, where you build a perfect strategy for the past that just fails miserably in the future. And finally, for reinforcement learning to even work, your simulation of the market has to be a perfect replica of the real thing, which, as you can imagine, is a massive challenge all on its own. Yeah, that problem of the market's rules being in constant flux, it actually has a name. It's called non-stationarity, and it is the single biggest killer of quantitative strategies, period. It means the very statistical DNA of the market is always evolving. So a model that you train on yesterday's reality is almost guaranteed to fail when it faces tomorrow's. But here's a really fascinating solution that a lot of top firms are using now. It's this idea of train on synthetic, test on real. So what they do is they use one type of AI, called a GAN, to generate massive amounts of fake but incredibly realistic market data. Then they take their trading AI and train it on all this synthetic data, exposing it to thousands of possible market scenarios it's never seen before. This forces it to learn much more robust, more generalized strategies that are way less likely to break when the real market inevitably throws it a curveball. And all of that, it brings us to our final thought for today. We've really journeyed from simple, automated rules all the way to intelligent, adaptive agents that can learn and act all on their own. And that is a profound shift. We're moving from just having tools that follow our instructions to creating partners that can actually make their own decisions. And it leaves us with a pretty critical question to ponder. When an AI can trade better than any human ever could, who is